Welcome to this Killick Explains video, and welcome to a topic that I've returned to a few times, generally when markets are volatile. And there's a question I get asked quite a lot, which is there a way to protect against falling share prices? And I'm going to answer, not really. None of the often quoted methods is ideal. Now, when share prices fall, investors can do 5 things. Roughly speaking, and we'll go through each one. 1, sell up, dump stocks, wait, try and buy them back later. Number 2 is to buy what are called put options. More about those in a moment. Number 3 is to buy what's called a short exchange traded fund, or ETF. Number 4 is to sell a future or a spread bet. Again, more coming up in a moment briefly. And number 5 is to do nothing at all. So which of those 5 is worth attempting? Well, let's take a look. So first of all, you're worried about shares in the short term. Maybe a cunning plan will be to sell them, wait, and buy them back cheaper. How difficult can it be? Actually, pretty difficult. It's a bad idea. It's called market timing. And it's incredibly difficult to pull off because lots of other people are trying to do the same thing, lots of algorithms are trying to do the same thing, and it requires you to get 2 decisions completely right. One is when to sell, and then the other is how long to wait before buying back. And in the meantime, it can be quite stressful because the stock market has managed to crank on upwards all the way through wars, Middle Eastern tensions, and so on. So what if you sell, and while you're waiting the market rises? That's even more stressful. So as a rule of thumb, trying to time the market in that way, never a good idea. Now what about buying put options? Now I won't go into this in too much detail. There are other videos that give you the technical nuts and bolts, if you like, but essentially a put option is where you hold on to your shares and you buy an insurance policy, if you like. You pay a one-off premium, which is not refundable, a bit like you would for an insurance policy, okay? And then you get a period of cover. So you might buy a 3-month put option. And the deal, basically, without going into the mechanics in too much depth here, is that if share prices fall, you exercise the option, you use it, a bit like an insurance policy if you manage to damage your car, and you get paid compensation for the fact that shares have fallen. So that kind of balances out in theory. But if you don't need the option, because after all, who knows, when you pay for it, share prices might rise, just as when you buy car insurance, you may never need it. No one knows the future. So in that case, you lose the whole premium. Now you might think, well, that's quite a good deal, isn't it? Because you're paying a premium in return for the possibility of getting quite a big bit of cash compensation if share prices fall, and you haven't got to sell your shares. But the problem is they're quite expensive. Usually when markets are most wobbly, these insurance contracts are the most expensive. Number 2, if you end up putting the option in the bin because you don't need it, because share prices don't fall as you were worried about, they rise, then you've lost 100% of the premium. So whatever you paid for it, that's all gone. And they're pretty difficult to get right. It's a bit like saying, well, why don't I sell shares, wait and buy them back? With an option, yes, you're getting a bit of insurance cover, but it's quite hard to predict the right length of time, how much to pay for the premium. All these things require a bit of expertise that most people don't have. So what about option number 3, the short exchange traded fund? Now you can't miss these. They've got exotic sounding names. They'll say this is a 2 times inverse FTSE 100 ETF. And again, without going into the mechanics in a huge amount of detail, because I do that elsewhere, link coming up at the end, what you're essentially doing here is hanging on to your shares, buying another one, which is an exchange traded fund, another share, but what it does, in theory, is it behaves the opposite way to the rest of the market. So if you imagine, if the FTSE 100 is going up, this thing will go down, and vice versa. So in theory, it's a hedge against the market dropping, because in theory, if the market drops, an inverse instrument is designed to rise and sort of compensate you, all right? But there are 2 or 3 problems with what sounds like quite a good idea. I'll cover these in more detail elsewhere, but there's a thing called daily repricing. Now, what that means is that it's quite hard to predict exactly how far and fast this inverse exchange traded fund will move. What I'm suggesting is, let's say the FTSE 100 goes down 1%, you might think this thing would go up 1% and everybody's happy. It sort of evens out. There's your insurance, if you like. But it doesn't work that way. It might go up by more than 1%, it might go down, it might go sideways, and take it from me, predicting that is not easy. They're relatively expensive as exchange traded funds go. Fees tend to be a bit higher, and as I've hinted, they're reasonably complicated for the average investor. So there's 3 things down. Number 4, selling futures or spread bets. Now, for those people who've done this on the outcome of sports matches, for example, you might be quite familiar with the concept of spread betting, which is linked to futures. Futures is a kind of institutional markets version of a spread bet. The deal is essentially this in financial markets. You could say, I think the FTSE 100 is going to drop over the next couple of weeks, let's say. So I'm going to put a downward bet at £2 per point. Don't forget the FTSE 100 is quoted in points, so today it's at 7,500 points. And for every point drop that you turn out to be right, the broker who set up the spread bet pays you £2 per point, or £5 per point, or £10 per point. All right? But if you get it wrong, you pay them. So it's a straight one-way, two-way deal, if you like. Market drops, as you expect, you get some money from the spread betting broking service, if you like. Market rises and you put on a down bet, you pay them. So there we go. Think of it as like a floodgate, swing gate. Now you might think, well, that sounds all right, that could work for me. Actually, spread bets are risky, all right? Very risky, actually. If it goes wrong, you can end up with an open-ended commitment almost. You need to put stops in, as they're called, to pay the broker. They're quite difficult to actually set up and use effectively, and they're only for the short term, like several of the other solutions I've mentioned. So that's number 4 down, if you're keeping count. Number 5 was do nothing. Here he goes again. Actually, it's the best option. It's a little bit dull, doesn't sound as exciting as putting a down bet using spread bets, and it isn't. The best bet is to buy shares that you're going to keep for the long term, and don't panic sell them. Try and time the market with put options or spread bets. Be patient. Markets do tend to rise over the long term. Can't promise that, but it has happened all the way through stock market history, if you like. You need to stay liquid, so you need to put yourself in a position where you're not using your investments as a cash point machine. I've made that point before. And you need to be rational. All right, volatility is the price you pay for the inflation-busting long-term returns that shares have tended to offer. So stick with it, avoid anything that sounds too exotic, all right, and avoid knee-jerk reactions to short-term market events. Okay, big topic, and I did mention there are some other videos that take some of these 5 ideas into some more depth. So killick.com/learn is a good place to go hunting for those, or the YouTube channel, Killick Finance Videos. Second place you might want to do some digging around is the guide sitting next to me, How to Invest in Equities. That would be editor@killick.com. And you'll find a few of these topics mentioned sometimes in our quarterly magazine, Confidant. And for a hard copy of that, or a PDF, editor@killick.com.